Let's discuss portfolio construction, key considerations and the current positioning strategies for client portfolios. So Peter Nevill from Viola Private Wealth joins me now in the studio. Thank you for being here. So how do you approach portfolio construction?
Thank you very much for having me. So the starting point always when we talk about portfolio construction is ultimately the client and their circumstances and really what we're looking for the portfolio to be able to achieve. In a very general sense though, there's always a few things that we're looking for every portfolio really to carry. So that's making sure that we're sort of number one, able to protect the capital over time. Number two, that we're sort of generating earnings growth and capital growth for the portfolio in order to protect the buying power of it over time. And then number three is just sort of pushing cash into the bank account, making sure we're producing income. So for all of those sort of three, really that comes down then to asset allocation and asset selection, of which there are sort of two key pillars that we look to. Number one is diversity, so making sure we don't have all of the capital exposed to all of the same risks, that we're utilising a number of different asset classes in seeking to produce returns, but also, and think of that I suppose in terms of the pizza getting sliced up into all the different sort of parts. We want each sort of part of that pizza to be able to generate a return in its own right and not be exposed to the same, I suppose, risks that all the other parts of the pizza are. The other bit's the asset quality piece. So making sure that what we're sort of holding in there, the underlying holdings, are doing what they say on the tin, that we're really comfortable around, the manager process. We're really comfortable around, what we're getting is what it says on the tin. So we've got a very sort of rigorous process that our CIO and investment team go through in order to sort of evaluate and take a view on assets within each asset class before any client capital sort of goes towards them. I suppose leaning into the private markets as heavily as we do, so assets that were previously just reserved for institutional clients, now sort of you're able to get sort of high net wealth individuals access to these things that we seek to utilise to better diversify portfolios, but ultimately to generate outsized returns over time.
Are you worried about private markets? I mean, some have seen some defaults and seen as risky by ASIC.
Absolutely. ASIC have been looking into, I suppose, private credit's the one that sort of comes to mind there, and that's where the due diligence process is really key. Remember as well, people have been lending money to other sort of businesses and people since the dawn of time. So it's nothing new, but obviously as the capital requirements of the banks have changed, they're needing to hold sort of more capital on balance sheet for some of the loans that they're sort of seeking to write. It's essentially driven them out of that space, which has then been sort of populated by those who are sort of doing it privately, like non-bank lenders. What we look for in that space, and again, the due diligence process is really key, is making sure that they've got long track records, are not a new entrant to the space, have been doing it for a significant period of time, are great at assessing the sort of counterparty risk, but have good protections in place around covenants, loan to value ratios, all those sorts of things, because it is the defensive end of the portfolio, and ultimately all it's there to do is just produce income. Where we want to take risk is where we get up sort of into other areas that are designed to be taking more risk. So really that's part of the portfolio construction process is ensuring that that's playing its role, but the other bits are playing their role as well.
So what are the limiting factors you look at when you're building client portfolios?
Yeah, of course. And that again comes down to sort of client circumstance, and there's a few of them. It's really around the amount of liquidity that's needed for the portfolio to make sure that lifestyle's being paid for, able to fund retirement in perpetuity. So we want to make sure that we've got enough liquidity in the portfolio that we're not having to sell assets at perhaps an inopportune time. So the liquidity piece is really key, but we don't need that much liquidity. So we're comfortable to utilise some assets that have longer lockup periods, because ultimately we don't need all of that capital back. Investment timeframes are really, really long. So even a typical retirement, you're investing for still 20 or 30 years. We don't need some of that capital back, so we're happy to get it out and invest it into assets that have longer lockup periods, as long as we're maintaining the liquidity that the client needs. The other aspect is the comfort levels. We don't want clients staying awake at night worried about what the portfolio is doing, if there's equity market volatility or what have you. So it's about taking on, an appropriate level of risk, that we're meeting the needs and the goals and achieving the objectives, but we're not having clients laying awake at night. it's also important to distinguish, risk in that sense between risk of impairment versus risk of volatility. If you've got mega cap tech companies in the US, sort of the capital value bouncing around, the likelihood of them going to zero is very, very different than, say, a speculative mining investment that's far smaller cap.
So what are the broader considerations you look at when you're managing money for clients?
Yeah, again, it comes back to the goals and objectives piece of clients. So in order to do the strategy bits, the tax structuring bits correctly, we want to make sure that we're paying as little tax as possible. So utilising things like family trusts and bucket companies. But superannuation is far and away the best tax structure that we have. So very much for clients, it's about on that journey, getting the right money in the right buckets over time. And that's usually, as we come to the point of being able to access it, having as much in that super bucket as we can. Because again, that 20 to 30 year time horizon, we want to be paying as little tax as possible through that period. So just those sort of strategic considerations that we provide along the journey. But the real focus is making sure that we're setting the portfolio up well.
And how are you positioning portfolios?
So we're very mindful that equity markets have run, really, really hard. They've done a lot of the heavy lifting for portfolios. It's really incumbent upon us to be able to source assets that aren't exposed to equity market risk, but can also produce a really good return in their own right. Again, it's that whole not having all the eggs in the one basket analogy. So making sure we're generating returns from those varied sources, because we are mindful that equity markets have run sort of really hard. So it's incumbent upon us to be able to source compelling opportunities that don't carry that equity market risk.